Good afternoon, everyone. The topic of today's conversation is evaluating a butterfly, which is kind of a broad topic, especially when you consider the fact that there are so many ways to configure butterflies. I've got a few of them in mind here. So with that all being said, let's just kick off a few ideas here. Allow me to preface this by saying I have just kind of one way that I'm looking at the SPX into the witching expiration. Again, you could do a video like this at any point in time, but because we have this event that only shows up, 4 times a year with the witching expiration, which is going to be 1 week from today, that is going to be a big part of what this is focused on. Now, I'm going to cover it with that way of thinking that essentially has me wanting to look for the SPX to move back into 4,000, right? Just with the idea, I'm going to go ahead and lay a horizontal on this. And I'm going to label this as a psychological price point. It's also a large gamma strike. And we'll leave that here on our charts with the idea that says we could see just about any kind of movement. We could go higher from here, exceeding the 200-day simple moving average. But if we were up into that area early next week, well, then I would look for a retracement back into 4,000 for next Friday. On the flip side, if we were to break the 100-day simple moving average, then that would be something that we could see basically the same idea, which is below here. Everything's going to start looking pretty bearish. And again, I could be wrong, and this could keep moving lower. But from down here into this area, I'm going to be looking for a reversion back into this 4,000 price point. So if these are some of the assumptions that I'm trying to work with in the current market, we can start to look at that through a few various butterfly ideas. Now, when you think about how, and of course trying to give you some of the tips or thought processes that will help you evaluate these trades for yourself as you find other instances or ways of setting them up, is just to say I put them all in the risk profile and then kind of assess them one at a time. So a lot of this conversation will be geared towards using it on Thinkorswim. If this is not what you're using, you'll probably have something very similar. But let's look at this 16th of December, right? This is the strike that I'm focused on that is, again, 7 days away from where we are now. And I'm going to be looking at the PM contracts, or essentially you'll notice that there are two 16th of December expirations. One of them notes the AM expiration, and the other is going to be your standard PM expiration. There's nothing inherently wrong with trading the AMs, but again, I'm going to give myself time with these ideas out into the close of next Friday. We'll start by giving ourselves a few more strikes. I usually don't list out all available strikes because in SPX there are so many of them that can kind of start to slow down the platform. But a few of the ideas that I am considering here, one of which is just the iron fly. Now, with us trading at 39.62 and placing the iron fly, you're going to have a directional opinion. But this is one of the first ideas that comes up for me because, it does emphasize a little bit of that bullish opinion, which we discussed, which if we're trading at 62 and I'm looking for the 4,000, that's going to be a little bit bullish. But then at the same time, it utilizes the idea that 4,000 has been a massive wall of resistance. Right, if we switch this back over to the volume and open interest, we can see that 4,000 strike does stand out, right? We've got 5,000 open contracts there, where most of your neighboring strikes will only have maybe 1,000 or a couple hundred. So it's thinking that if you did get to 4,000, that should be an important area of resistance. So I'm going to be selling that call option as well. Now, the way that I like to do this is either, usually is to right click on either the call or the put and then set up the sale of an iron condor. Now, again, this is just the way that Thinkorswim will label these. And by utilizing this strike to begin that drop-down menu, it will just put you on the right side of one of your considerations, right? In this case, we discussed the sale of the $4,000 call. So by clicking on that strike, that is the part of the iron fly that is automatically configured. Then we're going to want to take this and move it over into the $4,000 put, right? That's that one first adjustment that now leaves us short the 4,000 call and the 4,000 put. From here, you get to decide how much protection you would like to have. right? And this will definitely vary for everyone. There is a point of diminishing returns, right? Which is to say that you can go a little bit too far out. But for most traders in these spots, you're probably not going to be looking at them wider than $100. Again, if you know that you've got the account to back it, you definitely can. But let's start the idea with a little bit more modest risk. Something that will cater a little bit more to a smaller account. And I think the trade is worth considering even as small as $20 wide. So if we sell the $4,000 call, we want protection against prices exploding higher. That's where we buy the 40-20, because above 40-20, that kicks into the long side and hedges the position. Then, if we're going to make this equidistant or balanced on each side, the 4,000 put would imply the purchase of the 39.80 put, right? This makes us $20 wide on this side, and it's part of what makes these strategies kind of interesting. Here at a $19 credit, you're going to be looking at $1 of risk in both directions. So you do have to get the direction right with this, right? As we get further into evaluating each of these, and we're going to do a couple butterflies. Again, most of them focus on trying to do small amounts of risk with good reward. Again, the probability of this occurring just like this, is relatively small, but it's one of the few moments in time with that focus on expiration that I believe it's worth considering. So as you work to get your bearings for what these strategies will look like, one of the more helpful features inside Thinkorswim here is to go into this side menu here on the right, and I'm going to set my slices to break even on the day of expiration. And this just helps you think about what will the spread look like, or where will I make money on this over the course of the next week. So in the middle, right, is of this peak, is always going to be highlighting your maximum profit. And that would be if we did rally up into 4,000, then both of those options that we sold would be hopefully close to worthless. And that's where we take in the largest gain, right? The largest possible being $1,900, because we're opening up for a $19 credit. And then again, the break evens shown down here around 39.81, and on the opposing end at 40.19. So, this is one way of thinking about setting up these types of trades. And then from there, the next thing that I will do is start adding in, I kind of like evaluating those break evens for the individuals. And then what I'll do is go back and set slices. We can just reset them to where we now have this, at plus 10%, minus 10, and of course kind of sitting here at current prices. So inside that, now what we want to do is, because you think, well, and this will make more sense as we look at a few more butterflies, but you look at it and say, is that what really expresses your opinion the best? Or would there be something that maybe is a little different as far as the Greeks are concerned? This one actually showing up a little weird as far as the deltas. This is going to be partially kind of skewed a little bit because your premiums are so rich in here. It might make for a better discussion to look at it 50 wide. Let's just see if this changes the Greeks like I would like to see. It does make it into a little bit more of a bullish trade. You see just that 0.1 delta. But what I'm wanting to show you here is that once you think about it, you're trying to decide which butterflies may suit you best. Reading through the Greeks is always a good way of understanding it. So with this trade now adjusted a bit to further emphasize what I was wanting to show you, you can see that you've got a small amount of positive delta. So positive delta is going to equate to a bullish opinion. You have negative gamma, which means as delta goes in your favor, it will contract. It's essentially the opposite. If you have a long call and price goes up, well, then that's going to increase, right? Because the further your call goes up, the deeper in the money it is. So the more money you make directionally. This is just a little bit different, but then you move over to theta, again with the positive value. That means you're going to be making money with the passage of time. And then vega, the relationship to either expansion or contraction in volatility, and having a negative value, I'm essentially betting on higher equity prices, contraction in volatility, and that's one way of setting up this trade. Now, as the market kind of slides here, and it has had a pretty decent dip here from over about the past hour or so, so we'll see if 39.50 holds again today. That is a pretty critical strike, but the way that I want to show you is that's just one idea, and you can kind of evaluate it through your Greeks. Then the next thing you can do is look at it and say, well, if I like the idea maybe of moving up into 4,000, but I want to do it with a more bearish connotation, again, lots of ways of getting there, but the first thing that I think about is using an unbalanced butterfly that utilizes that same short, in this case, just the call side, right? So I'm still wanting to sell a rather juicy option, right? The 4,000 a week out is trading for $43. So there's definitely some premium there, but I want to give myself a way to make money anywhere lower and then up to, but not to exceed, 4,000. Once you think about how these butterflies and Thinkorswim has designed the platform to essentially work off of always thinking about the body, right? So once we've determined the body we want to use through, you can do it technically, or you can do it just off this psychological conversation that we've had so far. But once you have that body chosen, we're just going to right click on it and buy the Unbalanced Butterfly. Now, by default, this is going to use the strike width of its neighbors, right? So since we have $5 wide listings here in SPX, that single click is going to configure us with a $5 wide Unbalanced Butterfly. This is going for a $2 credit, which again, if you're new to these, the best way to understand it is to adjust the price, which by manually adjusting the price, you'll notice how it changes the lock here to the right of this. So you've got that is now locked in the price. And then to compare only this butterfly, let's uncheck the iron condor that we've previously configured. So by unchecking the iron condor, now the only thing that we're going to see is this unbalanced butterfly. And we get back into the conversation of the Greeks and just which of these best expresses your opinion. So in this case, you can see that a lot of the values are a lot smaller, right? Because we were discussing a 50 wide discussion, and this one is discussing a 5 wide. Now, once I adjusted this, let's move it up to 44. It's a little more accurate representation of what's really going on with the spread. But now again, anything that you're looking at and trying to think which of these best fits what I would like to do, first, we're looking at the risk profile, which always begin looking at this for two things. The first of which are your elbows. At least this is how I refer to them. You see the elbow here and the elbow here. Just these spots where you have sharp turns, and off of that turn, you then begin to level out. Because as long as that risk profile on the date of expiration levels out and it turns flat somewhere, that means that you have risk definition, that it can only get so bad, no matter how far it goes in or against that position. So you can see the elbow here, and also notice how these are made at our strikes. You see the 95, you see the 05, and how those are the points where the elbows kick in. Well, that's because either the protection, essentially the protection of those strikes will kick in at those levels, and that's why we see it in the way that we do. So further into understanding the unbalanced fly, when you go for a credit like this, the main reason you're able to execute the trade for a credit is because you're selling a multiple of the bodies, right? With these unbalanced, that's one of the first things that you'll want to notice is that it is a 1x3x2, and it is that configuration that focuses on the sale of a juicy premium body that allows the transaction to go for that credit. Now, you want to be able to understand it in both forms, which is to say, kind of doing the math in your head, but then as you get used to that, we'll use the risk profile to help describe it. So from $39.95, all this right here is $5 wide, right? You can see how it's 5 wide on each side. So this particular strategy, you'll take the width of those wings, subtract the credit, and that will tell you how much risk you have. So in this case, on a 1-lot spread, you have $300 of risk with the potential to make $700. Now it's important to understand that when you talk about max profit, it does have to land right at that body strike. And there's always a certain degree, I sometimes refer to it as a pucker factor, just an anxiety-inducing move where say the S&Ps just explode higher on Monday, well then you might be sweating this position as the index rallies and tests your short options. But if you can position size appropriately and kind of tolerate that move, as long as it could rally up a little bit above and then settle back in, that's going to leave you right where you want to be. But again, maximum profit is achieved at the peak. But then part of what I like so much about these strategies is that risk in only one direction. Where we compared the iron fly, you'll notice that you have where the elbows are on each side is below your zero line. I told you there's two things I want you to look for in the risk profile. One are the elbows, and then two are your zero line. Because the zero line is where we either are making or losing money. So you notice how with the iron fly, both of those elbows are below zero. So everything in that area would all lose money. It's very well contained, relatively speaking. $50 wide is going to yield a $6 risk on each side. But again, that emphasizes the Greeks a little bit better as to what I was wanting to show you. And you can see how the unbalanced avoids that. So see how they both have the peak at 4,000? They'll both do quite well at that price point. But as opposed to the iron fly that does not make money if we roll over, this does make money. It will not be the maximum, right? That's only achieved here, but it is the credit taken in. So $2, if the SPX goes to zero, you're going to lock in that $2 credit no matter how much further down it goes. So, this is one of the more powerful strategies that I have ever utilized. You can look at getting to these, similar risk profile graphs with other variations. Let's look at doing one of them here. Something like we're going to do now, a standard butterfly, just the 1 by 2 by 1, but in an effort to do something again that has, no risk to the downside, how would we achieve that? Well, remember that in butterflies, pretty much any fly, you're going to have the debit side and then you're going to have the credit side. So in this particular spread, I'm discussing the one here on the bottom, you've got the 95, 4,000 that would be the called debit. Then you have the 4,005 that is the credit side. So if we know that we're wanting and it's, again, when you discuss these spreads 5 wide, going at 15 cents, it's kind of a bouncy idea. But to emphasize the point, you just open up the risk wing, right? So now you're looking at this, which is a real similar strategy. Notice it goes for about $1.90 credit. But what the big difference is going to be your risk, right? Before where we were looking at that and we only had, and actually they end up being relatively close. I guess this is kind of what I point to also to say that a lot of times when these butterfly discussions come up, it can kind of be 6 of one and half a dozen of the other, right? This also, if you had done it for the $2 credit, you're going to end up being at about the same spot. So, at the end of the day, it's kind of just a deciding, I would say, because the way that I wanted to bring this conversation to you is that, and I learned it the most really around earnings trades, because around earnings trades, it was always so popular to look at doing something like the iron fly, which is just like selling the straddle or trying to trade within the market maker move. But so often, you wouldn't stay inside the expected move. You'd either have, maybe it was neutral, but I wanted to try to protect against those times when, basically to say, if you could just get the direction right, can you make money with it? And that's the modification against these types of spreads. So those are the first ways that I think about doing these. Again, with this, weakness here into the afternoon, it may not be a spot to put them on just yet, but I do think it's worth your consideration as we get into next Friday. And then there are one, if not two other spots that I wanted to give you just a couple more examples. Again, SPX, a great spot to do it because there's been so much focus on it here lately. It has some tax advantages if you really are focused on just trading that product. But to try to show you a few other ideas, I was looking at this in NFLX, which had a great move up today, but look at where it is pausing. It is right up into a relatively critical gap. You can see that from the previous earnings report, the bludgeoning that it took down into 230. And today, you've got a big move up into that gap fill. Now, like with all of this, if it just continues to move higher, there is risk involved. But I like to think that on a move up like this, could we stay below something like 350? 350 would be that next large psychological value. And it's not technical in any other way, but I'm considering the chance of that acting as resistance. So if that's one way you wanted to look at this, we'll come back over here to NFLX. We'll look at the simulated trade tab and go out into next week. Again, all of this focused on a little bit shorter duration expirations. So these ideas, if filled as noted, will come through relatively quickly. A week as opposed to something like 45 days and then having to wait 30 days. But again, it's looking at this and saying, all right, 350, you can see we've got a lot of activity there at that strike today. Those are relatively juicy. And that juicy term, I do think is a good one, but you can just, there's premium there that is available to be sold. If I'm looking at something that's 20 cents or 30 cents, not so juicy and harder to make a meaningful spread out of. But as we look at this 350, and we do exactly the same thing we discussed there over on SPX, except I'm going to use the context menu that is 2 strikes wide. right? You'll notice here how Netflix has strikes listed every $2.50, but I would like to skip over the 47.5 and skip over the 52.5. So I'm just going to right click on 350, buy the deep and wide 1 month 2 strike. You know, again, doing this through the context menu, the more you get used to it, really will speed up your workflow. And it also helps prevent execution errors against which is the single and which is the double. We already discussed the body, right? Which the whole focus is around the body because that's where we're trying to sell the premium. But if you're new to these, it's imperative that you get the single and the double contract on the other ends correct. By using those context menus, it will help you do that. So by looking at this spread now $5 wide, when we discussed it in the Voodoo Mastery this morning, I was telling you, if I could get this for $1, I think it would be an excellent trade. Well, that was kind of a fishing price, but it wasn't too far off. And it's something where if we had filled it at that price, you know, you've got a pretty good spread on your hands now. So what we do with this from here is just like we did with those others, that once it's configured here, you look at it through your risk profile. And now you think, okay, Netflix is currently trading the 325. So if we just hold the gap fill or move anywhere back lower, we're still going to make money. And that is a big part about this strategy that I encourage traders to realize, that even if you're doing them for small credits, and let's say, you know, you could get filled on this for sure at maybe 20 cents, you know, it would probably feel a little bit better. But even if you're doing it 20 cents or even a dime, doing these strategies for a credit is going to give you a much higher probability of profit than anything you do for a debit, right? With those debit style butterflies, you really have to land them right in the middle. When you go through this process of unbalancing them, you get the additional leniency, and again, only have to be right on one thing, and that is Netflix at or below 350 for that witching expiration. So again, that's a strategy I'm looking at. That's another spot where, and to contrast it further, and to show you why I think those are so powerful, or how you will see the probability of profit change so much, compare that to if you were to just buy this standard 1x2 by, you know, essentially the 5 wide standard fly. This is the difference, right? I feel like so many traders begin learning their butterflies by doing them with small debits. Well, yeah, you know, you're not going to lose too much with a strategy like that, but it just changes so much more drastically when you initiate, or when you add that additional short body strike. Again, that's going to bring in a good deal more premium. That helps the entire strategy go for a credit, and that will very much enhance that probability of profit over time. So I wanted to bring you the conversation in SPX. I wanted to bring it to you in Netflix. And I was also wondering if I could find it here in NVIDIA. Now, NVIDIA has a daily squeeze, which is one of the things that kind of gives me a little bit of pause. You know, it actually could advance further, but we are right here against the 200-day simple moving average. And by choosing my strikes here, I'm basically going to see if the trade makes sense off of the credit I can receive, or which is to say, can I do this for a credit? All right, so we know we're at resistance, and then when we look at this, it's really just like I was telling you, do we have options that are still kind of juicy? Well, 200, wouldn't that be a great place to sell? Because you're going to have huge psychological resistance, but there's no premium there, right? I can't really do the strategy when the body only yields a 23-cent credit. So we just move it down a little bit further. And usually about $1.30 is roughly the threshold that I'm looking at on the body. In this case, let's do it with that 185. So we're going to do the same thing. That is the purchase of a deep and wide 1 month 2 strike to skip over the 2.5 wides. But now you have that 180, 185, 190. So this trade does not work if NVIDIA goes to 200, right? If it explodes higher, usually you're going to want to do some type of management. You could either add a put credit spread, you could buy a vertical, right? There's a lot of different ways you could complement this trade, but I want to give it to you with that thought process that when you're doing it here for the 30-cent credit, or maybe this is even a spot to say, what if you moved it down to a 0-cent transaction? You can't really call it a credit. You can't really call it a debit. It's a 0-cent transaction. But even if you got filled at exactly that price, that could still be a good trade. What you do with that price is you are risking $500 for the chance to make $500. How often do you hear about that with verticals? You go just sell the vertical and you get the 1-to-1 risk reward. It is a pure coin toss when you do that. When you do this trade, you're getting coin toss, profit and loss, right? Risk 500 to make 500, but you're doing it with a drastically better probability of it working, right? If you think about it just from a point of view of delta, right? We look at these, and the body we've constructed this with is a delta 22. So it's kind of like saying there's a 78% chance that body is going to be out of the money, and you can see how that drastically increases your probability of profit. So I'm just going to take a few minutes to append the questions. We're going to start off with, on the first fly you presented, how do you not lose the $2 if SPX goes to 0? So what I think you're talking about there is coming back to this SPX idea, and we're focused on this unbalanced butterfly, right? So the 39.95, the 4,000, the 05, and this one again with that unique configuration of the 1x3x2. So when you say, well, how do you not lose the $2? It's understanding that the transaction as a whole goes for a credit, right? When we talk about spreads and you say, oh yeah, my spread expired worthless, that means nothing to me. That can either be excellent news or that can be very bad news. It all depends on, was your transaction a credit or a debit? If you do it for a credit, then that's a great thing, right? It has expired worthless in your favor. And again, the way that that all happens, or the way it can be done, is just the ratio of contracts, where you're doing more of them, right? And if you sit down and you put a pencil to it, you can look at the math, which essentially is just, okay, I buy one for $14, I sell three for $13, then I buy the two for protection, right? It's just essentially that configuration of the spread that we just discussed. And when you do them in that way, the fact that all of that math put together yields a credit, that's how the trade works, right? Because then you think about, well, if the SPX is at, let's say, 3,900, $100 below, all of the calls are going to be out of the money, right? We know that. That's easy to think about with options, right? If it's at 3,900, all of these are totally worthless. But since the opening transaction went for a credit, that's how you make money. And then what is a good idea for arrangement on the SPX right now in today's chop? Well, that is always the pivotal end of day question. And I wish I had the perfect read to give you right here. That all, like, if you could tell me where SPX would trade or where it would close today, then I could tell you exactly the strategy to put on. But for those of you that have been following my work for the past 2 days, you'll know how incredibly stuck this market is, because you've got, again, a couple nuanced levels, which I won't bore you with right here. But you see yesterday how 39.50 held so well. Then you've been sold off at 67. There's also a unique thing to be watching in this environment, that is the March contract, right? Almost always we're going to focus on that front expiration contract where you have the most volume. But do you see here how, looking out into the S&Ps, out into March, and do you see how that contract has just really struggled to get above 4,000? That's where it's kind of like, and this is just me being open with you. If you look at it and say, man, that's resistance, I'm bearish, well, then you could do, even that 4,000, of course, cash will be a little different. But, you could do the out of the money, call side, unbalanced fly. That strategy that I just discussed for Dan, you could do the same thing with a shorter dated expiry. Of course, the big problem here is I don't think you could go to 4,000 and get any kind of a meaningful credit. And I think that's really the only problem. If we come back and we're looking at SPX again for the 0 day, and you say, I do not think it's going to rally above 4,000. Well, nobody else does either, right? Because these options are already crushed. When you're talking about 10 and 15 cents, if you really think it's going back to 4,000, you just buy that call as a complete lotto ticket, right? It's not really a spot that we can think about that strategy, but I can go a little bit further with you. And this is super dicey, to be honest with you, because I'm not bearish in here. I could be wrong. That's the great part about presenting an honest opinion to you. If this whole thing just rolls over into the end of the day, I'll wish that I would have been bearish. But if I'm a little bit cautious on this, I'm thinking maybe we could pop higher into the end of the day, then this is a very tough strategy to tell you. But I'm going to tell it to you anyway, because I think it's a great place to understand it. All right, we already discussed why we can't do the 4,000, right? Great psychological resistance, but no premium there. So then we move back and say, well, in SPX, we do have this skyline at 39.80. That is a level that I think, if we got up into it, should hold as resistance. Okay, if we're willing to entertain that 39.80, then we're going to do that same thing with the body. Even just since I looked at it, it contracted about 20 cents. It's right on the threshold of where these strategies will go for a credit. But again, we discover our body by placing it, again, with a bearish tone, but saying if it does rally, I think we stay below 39.80. Okay, so we'll buy the Unbalanced Butterfly, and it just barely goes for a credit. That's where I'm telling you, this is still worth pursuing, and I think is so much better than taking shots with debits. Now, everybody's going to have a different opinion on this. Some will prefer those small debits and just lose and lose and lose, and then when it hits, it helps pay for all that. This is the other side, where this trade is going to win and win and win and win, and then that time that it goes completely against you in the final minutes of the day, you know, that's a little undesirable. But as long as we understand the conversation, you can see how, like, if we were having this conversation about a 10-cent credit on an iron condor, I would tell you, get out of here. It's a waste of time. Nobody needs to be doing 10-cent iron condors, but that 10-cent unbalanced fly, if we move anywhere lower, you'll just kind of scratch. You'll essentially cover your commissions. But if we do rally up, you see how, again, understanding it in your head, but then also understanding it on the risk profile is where the, you know, if you rally up into the skyline and that's where we close, that's a big win. That's a great trade. If we do go to 4,000, that is max loss, and it happens very quickly. If we just roll over, again, it's a small credit, enough to cover your commissions, but that's how I think about them. You know, you start with first what would be that great psychological resistance, no premium there, try to move it into your next available strike. And that's how I would try to get you something to think about into the end of the day. I know there was just a couple there, but you guys had thoughtful questions, so I did want to try to get to them. So again, that's the way that I'm thinking of SPX here. The other trade that it very well could be would be the downside. You know, I just gave you a way of thinking of 39.80 as resistance. If that works and we're headed back into 39.50, well then you could look at a couple different things. You could do that same way of thinking that just moves that body lower. Now, by doing the unbalanced in the money, that is a little bit of a different situation where you have to see this market move lower, but you'll notice when it's done for a $3 credit, that's pretty good risk reward, right? And again, think about these spreads, or I think they'll click the most when you think about them from their intrinsic value at expiration. So let's just say, again, for the sake of conversation, that it does fall 10 points and you end up kind of right at 39.50. At 39.50 to the penny, the 39.55 call is worthless, the 50 is worthless, and then you're going to be left with the 45 that is $5 of intrinsic value. So you take that $5 of intrinsic value, you add it to the $3 credit that you opened the trade for, you just made $800 while risking $200. You know, and while that does, you know, that has to happen pretty exactly, the other part of this trade that is favorable is you make money anywhere lower. So kind of like this theme we've been on, you know, I just finished it with you at 39.80, which used that skyline of resistance. If you're more straight up bearish, right, thinking that we're going to fall down here, well, then you can move your strikes, take in a better credit, and that's actually a viable way to approach the end of day strategies as well. Again, I wish I had a perfect read on it. It's not the easiest market to call into the close, but I hope that gives you some good food for thought as we get into these final hours of the trading week. So thanks again for being a part of it. You guys have a great rest of your weekend, and I hope to see you again next time. Hey traders, this is Henry with simplertrading.com. I wanted to thank you for watching today's video. I hope you found it helpful, and if so, be sure to click the like and subscribe buttons down below. If you would like to also see me putting these ideas into action and trading my own account live in front of you, be sure to sign up at simplertrading.com, and I hope to see you in the chat room sometime soon.